Hi class, this video is going to run through how to complete exercise 14.7 of our textbook, which you'll find on page 288 and the workbook templates on page 254. This is a great question because it's all about how we adjust the allowance for doubtful debts, but honestly, this question makes us do all three processes on creating an allowance for doubtful debts, writing off a bad debt, and then adjusting our allowance for doubtful debts in the new period. So it's a great question that tests the three skills that are all about this chapter. Let's have a look at this question. This following transaction is for a business called Encore Music Store. So let's just highlight the key bits so we know what we need to do. We are Encore Music Store, and one of their credit customers, N. Kelly, has done a number of transactions. We also know that the business has allowed for $3,500 of bad debts because they've created an allowance for doubtful debts. Our credit customer, new credit customer, has done a number of transactions in July. Firstly, it purchased some instruments for $4,200 plus $420 GST. It was a credit sale. We also had a credit sale to this customer of $2,700 plus $270 of GST. And then they paid $500. So it all seemed to be going well, but then unfortunately on the 31st, we received legal advice from the solicitors that the client was bankrupt. And because it's bankrupt, all the creditors are going to be paid, not everything that they are owed, and we're just going to get 35 cents in the dollar of what we're owed. So we've got some information there and we've got to do a number of things. Firstly, for A, we've got to prepare an entry to write off Kelly as a bad debt. So we'll do that first. Then we've got to think about what the ledger allowance for doubtful debts would look like. So we're going to have to think about all the debits and credits for allowance for doubtful debts. And then we're going to have to do what is actually the skill in the heading that we haven't done before, make a new allowance for doubtful debts because we have some new information. We had credit sales of $250,000, net credit sales, remember that's the important bit, and we have made an adjustment to decide 2.5% of these net credit sales will go bad, so we need to make an adjusting entry in our general journal to do this allowance for doubtful debts. This is what we're going to do. Let's go from the beginning. This is a great question because ultimately it gets us to think about this process. The first thing we're going to have to think about is how much this customer, N. Kelly, actually owes us. We know that we have a bad debt. We're now going to be paid 35 cents in the dollar, but this question asks us before we even think about that to work out how much they owe us. Let's go through it. This customer started from zero and suddenly owed us $4,620 because of the July 3 transaction, and then $2,970 because of the July 9 transaction. So if we add those up and then take away the $500 that they owed us, we actually realize that this customer owed us $7,090 when they decided to declare bankruptcy. So ultimately, we're going to have to write off all of this $7,090 accounts receivable asset, but we need to work out how much we're going to receive in cash. How much are we going to receive? We're going to receive 35% or 35 cents in the dollar of that $7,090. So if we do this down here, 7,090 times 0.35 equals quite an unusual number, and it breaks a rule that I've been telling you for a while to get a bit worried if you're doing decimals, but this equals $2,481.50. So we're going to receive, what is our first debit here on the 31st of July? We are actually going to receive some cash from these guys. So our cash at bank, being an asset, is going to go up, and you would never do this in your general journal, but just so we know, our asset is going to go up by $2,481.50. Assets going up are debits. We also know some other information. We also know, and this is a perfectly reasonable way to do this, that we know that we have $7,090 of accounts receivable that unfortunately we're never going to receive. We're going to have to reduce our accounts receivable by $7,090 because this customer is bankrupt. We no longer have an asset that just because they owe us money, we're going to have to remove all of this, and these guys are in Cali. Remembering an asset, which accounts receivable is going down, is a credit. We now need to work out how much is left and then ultimately work out how much of that is going to reduce our allowance for doubtful debts and how much is going to reduce GST. Because ultimately the money that we will no longer receive from this, we shouldn't be paying that GST back to the government. So if we use our calculators, and you absolutely would have to use your calculators for this, you would find that 7,090 minus 2,481.50 equals $4,608.50. We have to remove this, but remembering this is including GST, so this divided by 11 is going to equal $418.95. And this is the GST that we no longer will have to give to the government. So $418.95 is our GST clearing. And remembering, we always think of GST clearing as a liability, and our liability is reducing because we owe that amount less to the government. What is the number that's missing that adds up to 7,090? $4,189.55. And this is the amount of our allowance for doubtful debts that has been used up by this bad debt. This is our first general journal entry. It balances. We should absolutely do a narration here, and we would do something along the lines of adjusting entry, account written off because customer accounts receivable is irrecoverable, and that should be fine. We've got enough information that it says that we're going to get 35 cents on the dollar. If you had the room, you would. We know that the memo was 97, something along the lines that gives enough information that we know this customer has been written off, the debt is irrecoverable. You might want to say that 35 cents in the dollar is coming back in cash. That's actually a really hard skill to do, to work out A. There's a lot of moving parts there. So well done if you're able to do that. Well done if you're able to follow on. We now, in B and C, need to think about what our general journal would look like. So let's think about what our general ledger for allowance for doubtful debts would look like. Let's think this through. We've been given a few hits here. We know that on the 30th of June, we created an allowance for doubtful debts, $3,500. This was a way to reduce our assets. So we think of this as essentially an asset, and we reduced our assets via a credit for $3,500. Ultimately, we then have to follow the instructions for allowance for doubtful debts being a debit of $4,189.55. And this cross-reference is accounts receivable in Cali, and you would not abbreviate the accounts receivable. And this happened on the 31st of July. And that, believe it or not, is as easy as B is. We raised an allowance for doubtful debts of $3,500. Credit side, because it is reducing our assets. Remember how it looks like in the balance sheet. And in a weird way, this is not increasing our assets, it's just increasing, or if you want to think of it, decreasing what we originally did as our allowance for doubtful debts, because this is a negative asset account. Ultimately, all you need to be thinking about here is you are following your instructions in your general journal. Number C gets to the next period. We understand we have credit sales of $250,000 for the period, and 2.5 of them are estimated to will end up being bad debts. We need to raise a new allowance for doubtful debts, and we need to work that out. That is 250,000 times 2.5%, which equals in your calculator $6,250. So now we actually know the answer of our new balance. We want our new balance to be $6,250 in our allowance for doubtful debts. And that means our closing balance also has to be $6,250. So now we need to know what actually is our balancing equation and what is the new allowance for doubtful debts that we're going to raise. How do we balance? Remembering we add up both sides. If we add up both sides, and this is the left-hand side is the biggest, and it equals $10,439.55. This needs to carry on to both sides, and clearly our credit side is not as high as that. And now we have a dilemma. We need to work out what number balances this ledger. And using the power of your calculator, and you would always use your calculator here, you recognize that this number is $6,939.55. We, and we'll come to this in a second, understand that our cross-reference here will be bad debts, and we will come to that in a second. But this is how we've balanced our ledger. Now, I don't want you to be too worried about the decimal points here. It's probably unlikely that you'll see decimal points in your exam. This question gets you to do that, but we keep following the process. Number C also requires you to do a general journal entry. And we've worked out the number. We've probably done it the wrong way here. What is our general journal here, entry here? We know that we are doing a credit of $6,939, $6,939.55. And our debit also has to be $6,939.55. So what are our accounts that are debit and credited on 30th of June? Well, we are going to raise a bad debt, which would go on our income statement. Expense, that is an expense that increases, hence debit. And our credit is going to be our new allowance for doubtful debt. I am absolutely running out of room. You would absolutely do an narration that was probably going to be something along the lines of adjusting entry to increase I have absolutely breathed out that you wouldn't do that. To increase the allowance for doubtful debts to 2.5% of net sales. We have now done an incredibly complicated transaction. We have done arguably the most complicated transaction you're going to see in accounting for year 12. So, well done for following this on. This is difficult. What we have done here is worked out how much this customer owes us, understood that we're not going to receive all of that, so we have recorded a bad debt. We've understood that this bad debt has not resulting in an expense because we already created an allowance. we've updated the ledger, and we've worked out our new allowance for doubtful debts and the new bad debt that we're going to report in our income statement. If we think this through, why is the new bad debt $6,939 when we recognize that only $6,250 is going to really be a bad debt from the new net credit sales? We need to understand what happened in the previous month. We budgeted for $3,500 of bad debts, and we had a bad month. We actually had $4,189.55. So we underestimated, which means we need to now over calculate, have a bad hit to our income statement in the next period. Now, the question D then gets us to think about that the accountant has stated that the allowance for doubtful debts should be maintained in order to comply with the demands of faithful representation. Do you agree? This is a question that's asking you to think about what is the benefit of doing allowance for doubtful debts in terms of faithful representation. Faithful representation is essentially saying we should report faithfully what is actually happening in our business. We need to be doing allowance for doubtful debts. We need to be reporting bad debts because we know all these credit sales are not going to all be repaid. In fact, we are so good at predicting, we can estimate that it down to a small percentage of 2.5%. We would be overstating our current asset of accounts receivable if we don't reduce it because of these percentage of customers that won't be able to pay us back. And clearly you can see in the N. Kelly example, this often comes true, and we would be overstating our assets if we didn't record this allowance and bad debts. Guys, well done. I hope you've been able to follow this through. It is a complicated transaction, one to continually practice. So keep on working on your accounting.